It's going to be episode 22 of Green Stream, where logic meets life and investing. What we're going to talk about today, Pat, is rebalancing, how to think about optimizing your portfolio given your asset allocation target. So this is kind of the third conversation in a series of three. We started with maximizing that stock bond mix. Then we added in international stocks. Now we're thinking about how to balance kind of the stocks, bonds, international US exposure. And I guess the question we are trying to answer is, does rebalancing add value, and how does it add value? Because I think this is one of the misconceptions out there in the marketplace.
We're big believers that rebalancing does add value. I think you have to define what value is. That's going to be an important aspect of why you would potentially rebalance. But I think there's, a few reasons that make sense probably for us to get into on why rebalancing matters, why it's so important. I'll just start with maybe the biggest one in my mind, which is if you have a process for rebalancing, which, just to define it for our audience, I think it's probably straightforward, but it's the act of taking your portfolio from, having an asset allocation target and bringing it back to that target at some interval or some level. We'll talk about the different methods that you can take to get there, but that's kind of the process of doing that versus just saying, I'm going to let it go and kind of let it do its own thing, or kind of having more of a random approach of saying, I'm just going to buy this and sell that. I don't have an asset allocation target to it. So I would just say right from the get-go, the biggest benefit I see with rebalancing is the discipline that it brings to the portfolio management process. I just think that if you are consistently rebalancing, whether that be on some time basis or some other metric that you use to trigger a rebalance, it creates discipline to make sure that your portfolio is staying aligned with your overall financial plan and your overall asset allocation targets. Most likely you would have created a financial plan that has a required return that can map to an asset allocation, which then should be rebalanced regularly to stay on track. So, when you think about the process of rebalancing, the last thing I'll mention about why I think it matters and why I think the discipline part's so important is rebalancing occurs when there's been kind of movement away from your target. When does that happen? Well, that happens when either the market goes up a lot or the market goes down a lot. And so the process of rebalancing, if the market goes up, what does that mean? Well, if I have a stock bond mix of 60% stocks, 40% bonds, that means my stocks are heavier weighting than what my target was. So I'm going to be selling stocks in that environment. If the market goes down, I'm going to be, underweight my stock target. So I'm going to be buying stocks in that environment. And if you think about the discipline that means is that I am basically buying low and selling high compared to where maybe the market was, a month ago or 2 months ago or whatnot. So we believe that's one of the best ways to just stay disciplined is have a process and follow it.
Yeah. It takes a lot of the guesswork also about, hey, you're investing cash into a portfolio. You kind of have rules. We're going to talk about what those rules are, which means it's more likely for you to invest into the marketplace as opposed to the hesitation of, hey, I don't know what I'm going to invest in. It kind of establishes the rule process for how you're going to contribute your new dollars into a portfolio. If you're taking money out, it's going to establish, hey, what's kind of the hierarchy, the checklist? Again, we'll kind of walk through that about how you should think about withdrawing to maximize the use of those dollars. And then I think one of the points you made, which was, what is the value add of rebalancing? Sometimes people will tell you it's about expected returns in a market falling. I think that could be the case, but I do want to say that over time, we expect stocks to do better than bonds. So the act of rebalancing from an expected return lens doesn't really make sense, because if you don't rebalance, you should have higher returns over time. We would look at that and say, well, you misaligned your asset allocation. You misaligned the purpose. Why weren't you at a higher asset allocation to begin with if you were comfortable with that allocation? So when you look at the research, you really have to think about, okay, let's kind of like take expected returns a little bit off. And then let's look at two kind of considerations, which is, when do we rebalance? what's the cost of that rebalance? A lot of the way the research does is it looks at turnover, and you kind of compare that turnover against how different you are from your target portfolio. So that way you kind of get out of this style creep methodology. And then if you kind of think about, well, what are some of the ways that you can balance that tracking error, how different you are from your asset allocation, with turnover, the cost to actually achieve that. And turnover is a proxy for all these different things. It could be trade fees, it could be taxes, it could be bid-ask spreads. And what the research kind of shows is there's kind of two major approaches. You got the calendar approach, which says, hey, every year I'm just going to rebalance my portfolio. And then there's more sophisticated approaches, tolerance and tier tolerance, like we kind of think about.
Yeah, there's a lot of nuances when it gets into rebalancing, and I think we'll get more into the weeds on this. You made a really good point about the idea of, does this really add value in the traditional sense that I think people think of value, which is increase my returns. And I'll tell you that one of the ways I think we look at it is, and we've gone back and looked to see because the answer to that is it depends. There are periods for sure where rebalancing adds value in the means of higher expected returns. But over time, I totally agree with you that it should decrease expected returns, because we're basically going to be selling the asset class that has historically had better returns than the other. But if you think about it from a planning perspective as a client, let's think about the two scenarios. So when does rebalancing add value? It's when the markets are going down or very choppy. So the extended periods that we've researched where rebalancing really adds value is the Great Depression. There was 10, 15-year period there where the market basically went straight down and then came back up, and it was choppy in between too, but a long stretch where if you were investing, you weren't making any money basically if you just were a buy and hold investor. There was a period during the 1970s where we had really high inflation and the market basically chopped around for a long time and just ended up going nowhere for over 10 years. And then we had the period from 2000 to the end of that decade, where you had the beginning of the decade being the tech bust, and then the end of the decade being the financial crisis. Another period where you had ups and downs in the market, but when you started to kind of look at it over a 10-year plus stretch, you realize you didn't really make any money. So in every one of those environments, if you were rebalancing each year, you think about what was happening. Well, the market went down. We would be selling bonds and buying stocks to get back to our targets. You get in this place where when you look at it after the year of my two scenarios of do nothing versus rebalance, I had more value. I made more money if I rebalanced during those choppy stretches. So that's the one scenario.
So the worst case scenarios is when you see a lot of the value being added.
That's the key, is because the alternative is where I don't get at value add is when the market's going up, kind of like straight up, kind of like a period we've been. But if you still look at your portfolio, you are meeting your goals most likely because you are doing very well. You still have a healthy weighting in stocks. You're just not going up at the level of the stock market. Maybe the stock market's going up at 15% and you're only going up at 10 or 11 or 12. You still probably can meet your goals. So there is a smoothing effect that this does with rebalancing, where yes, when the market's going straight up, you're probably getting a little slightly lower returns because you're, rebalancing out of stocks. But when the market is choppy and going down and popping back and forth and whatnot, you're probably getting higher returns. And so you get this a little bit more smoothing, which is much more valuable in the planning process when we're trying to plan for someone, say, retirement withdrawals. We don't want to have big ups and downs. We want to have smoother returns.
Yeah, that's super, super interesting just to think about those worst case scenarios versus the best case scenario. And what are we trying to plan for is probably how to react in the worst case scenario, because on a relative basis, that might be a little more impactful. And yeah, I jumped into the nuance of rebalancing. Let me just set the stage a little bit. When you look at the research, the difference between some of those approaches I was talking about, calendar versus tolerance band, it's probably 10, 15, 20 basis points of expected return difference kind of between those approaches. And for a calendar year, you could do once a year, once a month, once a quarter. But essentially, the more often you trade, you're going to be increasing costs. So what you're trying to do when you rebalance a portfolio is you want to rebalance with the lowest cost. And then you also want to rebalance in a way that best repositions your portfolio relative to the asset allocation. So calendar rebalancing, I don't think it's bad in any way. It's maybe about 10 basis points less efficient. But a lot of like, if you look at inside a 401k and you say, hey, how do you want to rebalance? It's going to essentially say, do you want to redo this once a year? Whereas somebody like us, who we're kind of looking at this stuff every single day and using systems and focus to do it, we're going to be more tolerance band oriented. And so, Pat, maybe it'd be helpful just explain what tolerance band is.
Yeah, in the kind of continuum of rebalancing, I would say on the one end, you have no rebalancing, which is the worst scenario. Then you move on to calendar rebalancing, which is better than nothing. So it's good. You will, time based, basically it could be quarterly, calendar year, but basically it's just something automated, or you just set a reminder for yourself, go in, rebalance the portfolio on this date. I'm not going to look at anything else. That's all I'm going to do. And then the other way, which is how we're doing it, which is tolerance bands, where we're basically saying we will only rebalance the portfolio when it gets outside of some stated tolerance that we're using. I'll go back to our 60-40 portfolio. We might say if it goes past 65% equities, then that's a trigger for us to rebalance the portfolio. And the reason you would do that is, again, to your point of lowering costs. If I have a portfolio that every year it's just going to rebalance on 1/1, and I'm at 63% equities, there's a cost to do it. You have to weigh that. And so it could be tax costs. There could be other trading costs involved. And so just to trade because it's a certain day of the year, to us doesn't make much sense. What you really care about is how far away am I from the target of what I've set. So it does take more work because you have to monitor the portfolio basically all the time. And that's, we have technology here that does this on a daily basis to monitor it. So we believe that's the better way to go, but it does require some more time and effort to go into it. And yes, it probably does add some value over time to do that. The one last thing I'll mention with that is we're making it very simplistic in just a stock and bond mix, but there's a lot more levels to it that you have to start to think about. So if you have a properly diversified portfolio, you may have 3 or 4, 10 different, asset classes within your stocks. You might have US large cap and small cap, and you may have international emerging markets and value and growth and all these different things. So at the high level, yes, you want to be, in my example, 60% stocks, and maybe the 65th percentile is when you rebalance. But what happens when you have one of those sub asset classes that grows a lot and maybe the others are shrinking, for example? You're still within your tolerance bands at the equity level, but your sub asset classes start getting out of whack. So we have a way we think about that. We have tolerance bands at the sub asset classes and at the asset class level. Asset class level always takes precedent, and then sub asset classes are kind of next. The last thing I'll just mention, and there is not a right answer for this, is what should your tolerance band be? That's kind of a preference that you need to think about. The wider the band, the more variance you're going to have from your target. So you're going to have a lot more kind of volatility with the portfolio, most likely. You're going to have less costs, which is probably a positive for making sure the bands are wide enough. But you will have, more potential losses and or gains in the event of market movements, because you're just going to let the portfolio run a little bit longer. So a portfolio that is 70% stocks is going to be more volatile than a portfolio that's 63% stocks, for example. So if you're not rebalancing, you're going to just see more volatility. You have to be okay with that. Those are kind of preferences you have to decide on.
Yeah. And the tolerance band, one of the things that's super helpful about that is it kind of makes sure that you're out of this de minimis spot. Because the worst thing, hey, if you're 60% equity, it actually doesn't take that long for the market to move you to 62% equity compared to bonds. Given volatility, that could just be a week. So if you set it too tight, next week it could drop and it could go back down to 60. So that's why we just try to think about having a rule-based approach but giving some flexibility, just given volatility, and then thinking about each asset class. What's the volatility? What's the likelihood that I'm going to kind of trade at the wrong time? And it's just market noise, because markets are way noisier than most people think about.
It's a good point. And, portfolios do move around quite a bit, especially the equity portion of your portfolio. So if you have a very tight band, it's going to require a lot more trading, a lot more monitoring. The one other thing I would just say that I've seen some investors make a mistake is they have this plan and they don't follow it, because rebalancing really goes against all the instincts that you have in your body. Usually if you're doing it the right way, which is market is tearing higher. You're like, wow, do I really want to sell this? It's done so well. Do I really want to sell Nvidia? It's gone up so much. Why would I trim this right now? I don't want to pay the taxes. You can have lots of justifications for it. You see that decent amount on the way up. I really see it from investors on the way down. I remember in '08, we followed this approach, and I remember getting calls from clients because we have discretion. We trade portfolios based on an investment policy that every client has, to stick with the target. And when, the market dropped 50-ish% over the course of '08 and '09, in the midst of that, we were selling bonds and we were buying stocks. And I remember some of the calls saying, I can't believe you're selling the only thing that seems to be working for me right now, and you're buying the thing that looks the worst. And why would I want to do that? And, you go back in time and you say, wow, those are the best trades you ever made in your life. You'll never see prices like that again. But in the midst of it, it is really, really hard to follow it. So having a rebalancing policy makes a ton of sense. People will probably listen to it and go, yeah, that makes sense. We should do that. It's easier to do in theory than it is in practice, because you have to deal with the emotions that come with losses and gains in the midst of, really tough markets.
Yeah. And for somebody like us, it's kind of why advisors at Max work with about 100 people, because not only do you have to do those trades, if you think back to COVID, I can't remember how many days of a drawdown, 20 days of a drawdown, you have to make all these different trades, in many cases, multiple trades, because it's on the way down. But you also have to make sure people are super comfortable with an understanding of what's happening. What are we learning about asset allocation? What are we learning about risk tolerance and risk preferences? So it's kind of balancing those two things. And if you're left to your own devices, that's maybe where you might think about a dedicated asset allocation fund that's going to kind of make those decisions for you, that loses some control. But also, if you're working with an advisor, just making sure you're aware and you're comfortable with what's going on. And I think the other balances that we run into is also, there's a lot of reasons why, to your point, Pat, it's a tough line between a reason and an excuse for why you might not make a trade, right? And for instance, we might look at a situation right now, it's getting towards the end of the year. We might be thinking about somebody's tax situation, say, hey, it would be really unfortunate if we were to sell equities because they're outside of our tolerance band a month before somebody's capital gains budget can kind of reset. And next year they might be in a lower capital gains bucket in terms of taxes. So, hey, I don't know, we're trying to work with them to figure out, hey, just pushing this trade a month, is that actually going to be more efficient for the client? And again, just having outside perspective to think about reason or excuse, I think is helpful.
I think we'll kind of walk through the ideas of how we think about rebalancing in practice, because, it's one thing to say, oh, it's time for me to sell stocks and buy bonds, but then how do you think through it is going to be really important. But I do want to touch on your point of, if you're working with an advisor, I believe this is an important aspect, is making sure that they have the time and resources to think through those things. And the issue with it is, and this is maybe a little bit of inside baseball for people listening, is that when we rebalance a client's portfolio, it's almost always everybody's portfolio is being rebalanced at the same time, because the market is doing the same thing to all of our clients' portfolio at the same time. So COVID is such a great example where it was more than 2008 for me. in more than 2000, it was the most intense period because of the magnitude of losses in such a short period of time. So if you were trying to rebalance portfolios, you had to be looking at it daily. And if you had 250 clients, there is no way you could have kept up with what was going on during COVID. We were all hands on deck. Our average client ratio is probably at the time was 60 or 70 clients or so per advisor. And we were every single day dealing with trading because again, when it keeps dropping like that, you are rebalancing pretty soon. You might rebalance 2 or 3 times throughout that. And then you have 60 people you're doing that for. So just maybe a little bit of something to think about for investors and for our audience is if you're looking for someone to do this effectively, in my opinion, that's one of the most important things is do they have the bandwidth to do it? And that means client caps or numbers of clients per advisor, because this all happens at once for the most time for a firm. It doesn't happen like, oh, I'll rebalance this person today and I'll rebalance this client next week and I'll rebalance this client. If you're using tolerance band, the market moves all at the same time, and that requires you to have some nimbleness there.
Before we jump into, we're kind of talking about the extreme case, and then maybe I think it'd be helpful to talk about day-to-day kind of normal market environments. How do you think about this stuff? But while we are on kind of these extreme cases, maybe it'd be good just to talk about tax loss harvesting, especially in an environment where, again, tax loss harvesting, when an investment drops in a price below what the cost basis is, you can sell that investment and you recognize the tax benefit. And why the government sets this up is they want to encourage investment. So they don't want you to be discouraged if one particular investment loses money. They want to allow you to recognize that as a tax benefit and keep you as an investor. And there's some rules around that. But when markets are dropping or an asset class is dropping, that's another reason why there might be trading. And oftentimes it coincides with a rebalance, but sometimes not. So maybe just talk a little bit about tax loss harvesting.
Yeah, it's fairly simple. It's the idea of selling an investment that's gone down to harvest or, kind of retain this loss that we can use against future gains. When you think about it, really what it is it's a tax deferral strategy for the most part. I mean, there's some ways that you could almost, we could talk about how it could be a tax avoidance, but it really is a tax deferral strategy because if I buy a stock for $10 and or a fund, let's say U.S. stocks for $10 in some sort of ETF or whatnot, and it goes down to $6 and I sell that, I don't want to necessarily get out of U.S. stocks. I just want to recognize the loss. So what we do is we would say, well, let's just sell that particular U.S. stock fund and put you into another U.S. stock fund, just reinvest the proceeds into something very, very similar. And by doing that, we still have $6 in U.S. stocks. It's just now we have this $4 loss we can use against gains in the future. So that sounds great. Obviously, I have this loss. I can avoid, paying taxes. But the other side of that to remember is that I now have basis in my new stock fund at $6, not $10 anymore. So I have a bigger future tax liability. But as an investor, I would prefer to get all my tax benefits now versus in the future. It's just time value of money. I want to get the money in my pocket now and I want to pay taxes, later if I can. So that would be, kind of the thought process. But in the context of rebalancing, this is another part of it is when you're rebalancing a portfolio, what we're always looking at is, are there opportunities to tax loss harvest so that we can build up a pot of losses that can be used against gains in the future?
Yeah. And, if you go back to that COVID example, if you're invested in something, a primary position, right? Something we recommend, we recommend it because we think it's the best investment in the asset class. That's why it's recommended. So by definition, the next investment is not as good and it can't be the exact same strategy. It must be a little bit different. But then this also gets into why some of this stuff is helpful because COVID, you don't know the top and you don't know the bottom. So you're kind of doing this process on the way down. But I was working with, in my last job, advisors that would do this 4 times on the way down. By the 4th trade, there's something called you can't reinvest in your original thing for at least 30 days. So by the fourth trade, how good is your investment product that you're investing in compared to your original? And I think that's also something you can't just go about these processes blindly. You have to really be thinking about the trade-offs and trying to balance after-tax expected return for the big picture, which is really tough because it's easy to break things down in components. Hey, this is a basis point more expensive. That tells me a little bit about future returns, but not the whole picture.
COVID was such a weird time for investing, but I remember having an emergency meeting of our investment committee because of exactly what you said. We had gone through like we typically have for every investment, we have a swap alternative for tax loss harvesting. And we had gone through that. We were hitting our third one because we couldn't reinvest back into that original one because it hadn't been 31 days yet. So it was a strange time for sure. Maybe we can talk a little bit about, kind of some of the processes or thought processes on how to actually go about doing this. So hopefully we've convinced everybody, yeah, it probably makes sense to rebalance my portfolio. Maybe you can make a decision on calendar year versus tolerance bands based on your preferences there and how much time and if you're using an advisor or not. But then it comes down to, okay, well, like practically, how do I do this? So I think there's two elements that maybe we could talk about. One is, there's kind of, we were talking about this earlier. There's two elements of like how a portfolio is kind of being managed. So there's one where no money's coming in or out of it. It's just, I have this money. I've been managing it. It's there. It's going to go up or down. And so when I do rebalance the portfolio, I got to sell something to buy something. Basically, there's no extra cash sitting around that I'm putting in. The other scenario are clients that are putting money in or taking money out regularly, and that creates an opportunity to rebalance. So I'll start there because that's the easiest one. The easiest scenario by far is if you are adding to a portfolio, because all of your new contributions, it's a math equation. You can just go in and figure out, where am I underweight? That's what I'm going to use to rebalance the portfolio. There's no friction, no taxes. Yes, I have to buy something, but I don't have to sell anything. I can just use all my new money to rebalance. The alternative of, I either have to, I'm taking money out of a portfolio. So this would be like more of a retiree scenario, is now I have to make some decisions. I can use the outflows to rebalance, meaning whatever's up, that's what I'm going to take from. But it's not always that simple. If I'm 60-40 is my target and I'm 61% stocks and 39% bonds, and that 1% extra is going to cause a big tax hit if I go to use that to rebalance. Do I want to do that? Or should I take from bonds, still stay within my tolerance bands? Those are kind of harder decisions that you have to think through as an investor.
Yeah. And on the accumulation where you're adding to a portfolio, you're contributing, we think it's easy because we have these rules-based processes. We look at it and we say, on a relative basis, here's what I want my exposure to be. And here's the asset class that hasn't been doing as well. So we think that's an opportunity to, in a sense, buy low. We still get a lot of questions from clients and prospects. Hey, I'm making a little more money. I have a little more money this year. How should I think about investing that? Right. So for us, it's easy because you have a rules-based approach. If you don't have a rules-based approach, it's not an easy conversation because you don't know from an expected return standpoint, where is the best place to put my money. So this is one of the areas where doing your work ahead of time, I think, is really powerful down the road because it simplifies a lot of the carry-on investing decisions. In that other portfolio sense you were talking about, there's still an opportunity to rebalance, even if you're not adding money or money coming out of it. And that's by, instead of automatically reinvesting dividends, take those in cash. This is very simplistic, but one trade is better than two trades is essentially the whole idea, which means anytime you have cash in a portfolio, it gives you an opportunity to rebalance. So distributions from dividends give you an opportunity to rebalance. If you're unfortunately in some legacy mutual funds that have big capital gain distributions, we still see a lot of those. They distribute in up markets and down markets. It's just kind of a weird structure of the mutual fund format. But that's an opportunity to say, hey, I don't have to reinvest in something that's tax inefficient. I can take that in cash. So I'd say those two things. And then, Pat, maybe it'd be helpful just for somebody to, like, let's just role play. And, hey, Pat, I want to take $20,000 and go to Europe. What type of decision tree is an advisor thinking about to make sure we get that money in the most tax efficient way possible?
Yeah, I'm going to start at the very beginning of how somebody should think through that, because I think it's a really great question and happens all the time. So first is this in alignment with my financial plan? So this is probably even more important than the rebalancing discussion is I've set up, hopefully, if you have a financial plan, some sort of spending plan. Here's how much I expect to spend. Is it in alignment with that, or is it way off? And if it's way off, then there should be a discussion of, do we need to change our plan? But let's just assume you can check that box. Yes, I was planning on going to this trip on this trip. Yes, I was planning on spending this money. Check that box. Okay. The next is, where am I from a target allocation standpoint compared to what my plan says? So my plan has a certain return that's required. We've mapped that to an asset allocation that we think has a high probability of achieving that return. So how far off am I from my target? And if we've been using this example of 60-40. So am I exactly on 60-40? Am I at 62-38? Am I at 70-30? Maybe I'm pretty far off my target. So that would be the next, kind of decision point or thing that you want to look at is, where am I compared to my target? And then it comes down to, how do I execute on this? So let's just assume, because almost in all cases, you're going to be off target, but now you'd want to look at, am I inside my tolerance band or outside my tolerance band? If I'm outside my tolerance band, fairly simple, in my opinion, is you place the trade that gets you closer back to your target, irrespective of taxes. Typically, we want to if I have to put a order of operations, if you will, on things, first is we want to make sure our portfolio is in alignment with how much risk we're willing to take. Second would be to optimize for tax. So if we are outside of that band of risk, then we want to try to get it closer. And then you kind of get into, let's say, so that becomes a fairly simple conversation. But the other one would be, I'm inside my tolerance bands. What do I do now? So now you're starting to look at tax optimization for the portfolio. So are there tax losses I can take to offset anything? Are there other things I can do? Which account do I take it out of? So I have an IRA. I have a taxable account. Do I want ordinary income this year, or do I want capital gains? And, normally you want the thing that'll generate the least amount of tax, but not always. If you're in a really low bracket, maybe you want to generate higher taxable income because you're not paying much in income taxes this year. So something simple like what you said of, I need $20,000 to go to Europe, there is a multiple kind of levels of decision making that has to be thought through to do it well and to try to optimize that. And we've always said, we want to basically try to make the best decision possible with the information that we have, and do that over a long period of time. We know that our clients are going to be put in a very good position if we do that. It may not always work out perfectly every single decision, but over time, we feel like if you make good decisions, you will eventually get good outcomes. So anyways, that's probably the thought process that we have going through it.
I think that's super helpful because, again, like, we kind of do this all the time. So I think it's pretty easy for us to go through that checklist. But if you're not doing this all that time, you would hate, if you can take the money and go to Europe, you would hate for it to become a friction in your life that's preventing you from having fun on that trip to Europe. I'm going to Europe, as you know, in like 3 days. So this is a little hot on me. What about the opposite end? Because I think maybe there's some oversimplification I mentioned earlier, but you're working and you say, hey, I actually think I want to contribute more. I have more excess cash. What's kind of the thought process there when it comes to maybe some of the different accounts or some of the deeper level thinking we might do with somebody that everybody should be thinking about?
Yeah, it's similar. There's just some nuanced differences to it. So one, I would start with the plan. and say, is this savings in conjunction or in alignment with what our plan says for how much we're going to be adding to the portfolio? And let's just say it's not. Let's say it's more than we were expecting. We were expecting to save $50,000 a year, and you've been consistently putting $100,000 a year in. I mean, great issue, obviously, but I would start there, and then that would potentially have us revisiting our asset allocation, or at least a conversation about it to say, can we afford to take more risk now? Or conversely, could be the other side of that coin is we have enough. You're saving so much more. We don't have to take that much risk to achieve your goals. And that again comes down to preference, but that would be number one. So that's irrespective of the rebalancing, but that would help us decide, is this the right target that we're rebalancing back to? Let's assume it is. Then at that point, obviously, whatever we're underweight in is what we're going to look to buy. But again, we'll also look at which account should we be buying it in? Are there other factors around like future outflows or inflows that we should be factoring in? Typically is, if somebody's putting enough money in, you're probably buying a little bit of it's not like one thing you're buying. A lot of times, hey, I'm putting in $100,000. Usually it would be like, well, you're $30,000 underweight bonds. So you're going to put a little bit more in bonds, but you're still buying stocks. It just might not be at that 60-40 split that we've been talking about. So, but that sometimes is hard for people because you're buying something that hasn't done well if you're rebalancing the right way. And most of the time people don't love the idea of that. But again, make the right decision over a long period of time. You'll get good outcomes. You'll smooth the returns out, which is again, one of the big benefits of rebalancing.
That's well said. And, sometimes I think, hey, if all this sounds like super complicated, one of the other decision points is the more individual investments you have, it increases in complexity, like exponentially, right? And there are solutions out there where you kind of give up some of the control to do tax loss harvesting and sub asset class levels, maybe a home bias that you liked or you preferred. There's options to give up a little bit of control and just go with a one fund solution or something like that. This is one of the great things about target date funds too, and managing that stock bond mix where if it's not a taxable account, hey, listen, I don't want to do all this. I want somebody to do it for me. And every single investment is doing these rebalancing for you in a sense. I would say the more you break it, maybe we'll just spend a few minutes talking about more vehicles, what that does for flexibility, but also the exponential challenges.
Yeah. So again, you can kind of be on a continuum here. I'd say what you mentioned probably on the one end would be something like a target date fund where it can perfectly fine for a lot of people, especially if you're not working with an advisor. It's kind of a do it for me type of approach. They're going to set your asset allocation for you. They're going to rebalance for you. It's all going to be done internally. Is it optimal? Probably not, most likely, but it's better than maybe the alternative of not knowing what to do. So I think it's a good step. As you move along, obviously you can break out that target date fund idea into different asset classes and different investments. And the more you break it out, the more opportunities you have to rebalance, because not everything, and especially more opportunities you may have to tax loss harvest as well, because the more that you break it out, the more opportunities you have to rebalance it, the more opportunities one of those things, or maybe multiple, may go down in value. So, instead of having a target date fund, you might say, I'm going to buy a US stock fund, an international stock fund, an emerging stock fund, and a bond fund. Well, now you have 4 different investments. They may not all go up and down at the same time. So you're going to have to be on top of rebalancing that, but you also have opportunities to tax loss harvest. So it can save you in taxes. There is kind of another iteration of that has become, I'd say, more popular over the last 10-ish years, maybe a little bit longer than that, but where I think technology has gotten to a point where it's allowed us to say, let's take that even more to the extreme to say, instead of just owning a US stock fund, we're going to own all the US stocks that make up this fund. Some people call this like direct indexing or separately managed accounts. But the idea there is I'm kind of doing this on steroids mostly for the purpose of tax loss harvesting, where I'm going to own the S&P 500, but instead of owning it inside of a fund, I'm going to own all 500 stocks. And I know after a year, even when the S&P goes up, there will be elements inside the S&P that will go down, some individual stocks that I can use to tax loss harvest. So this is kind of the continuum. And in the cases where it's like a target date option, all the rebalancing is being done for you. If you get all the way to the other side of that, where you're really breaking it out into very, very individual components, that's where either you or an advisor need to be much more engaged to make sure that A, it's being rebalanced, and B, you're optimizing it for tax losses.
Yeah. And what we're trying to think about is just what's the right spot on that spectrum for every individual based upon their unique needs. And commingled solutions, mutual funds, ETFs, mutual funds, if done tax efficiently in taxable accounts, ETFs kind of mostly have these taxable benefits. But when they can essentially rebalance for you, because all the other investors of those funds, when they're buying and selling, these investment managers should be using those cash flows to better position the portfolio. The more you break down the components of that, the more you really have to understand exactly what's happening. There's a lot of different small cap funds. If you break that out as a separate asset class, are you sure what you're buying when you're buying it is really small cap? And even with the index solutions, that's not exactly clear. But I think, examining the spectrum, and especially not overemphasizing tax benefits if it's not going to apply to your unique situation, right? So if you don't need a lot of losses, you might not need the extra complexity that honestly makes a lot of the other rebalancing much more difficult. So I just think figuring out what's the right balance in terms of number of funds, and sometimes less funds, people might think, that seems less sophisticated. Not necessarily. That might actually be a much more efficient total return approach compared to more funds with less efficiency. And there's research that kind of backs that point as well.
Great point. There's one last thing on, I would call it the practical implications of rebalancing that I want to just touch on. And that's the idea of, again, this might be getting into the weeds, but hopefully the people that listen to this, if they're into this, they might enjoy it. It's, should you be rebalancing at an account level or what we call a household level? So what I mean by that is, let's say, my wife and I own four different account types. We have a joint account that's fully taxable on all the dividends and interest that we receive. We both have an IRA account that's tax deferred until we take the money out. And let's say she has a Roth IRA, which is tax-free, all of the growth in it. So each one of them has different tax characteristics, basically. So one approach, which is the account level rebalancing, is each of my accounts has its own asset allocation and target. And I rebalance each account back to that. So my joint account has a 70-30 mix. My Roth IRA has a 100% stock mix. My IRAs have a 50-50 mix. And so I am just looking at each account and rebalancing it back to its target. So that's one approach, obviously, to look at it. The other approach is household rebalancing, where I say, well, all of this money is all going to be used for the same thing, which is maybe my own retirement. And so I would like to have on average about a 70-30 mix, but let's look at what creates the best tax optimization in my portfolio. And so it might be that, yes, I want to have 100% in stocks in my Roth, and maybe I want to have lower equity weightings and more bonds in my IRA, because my IRA, I don't have to pay tax on. Bonds generate interest income. I would use it for that. Maybe more stocks in my taxable account. But so if I looked at every individual account separately, they may look kind of weird. But when I put them all together, they come up with a 70-30 mix. And so this whole idea, people call it, asset location, and it's really around tax optimization, but it does impact how you rebalance. If you do the household rebalancing, I will tell you the level of complexity goes up significantly when you have to start rebalancing, especially when you're taking money out, or you have to just rebalance a stock bond mix, because then the question is, well, not only do I have to, for example, stocks are up, I have to sell them and put it into bonds. So now I have to think through, A, do I want to make that trade to rebalance? But now, two, which account do I want to do it in? Because I have stocks in different accounts. And it's probably a whole other episode to get into on how you think through those kind of options. But I would say there is there's different, I guess I've seen different research on this as far as the actual value added by doing it this way to try to save an after tax, create higher after tax returns. But it's something for listeners and the audience to think about is, okay, am I going to do this at the account level, or am I do this at my overall household level with all of my accounts?
I think two of the big decision points leading into that is it's kind of legacy. What does your asset mix look like in the accounts going into that conversation, right? If you don't have that many different accounts, that makes it easy. Legacy positions make it more difficult because you're trying to think about working around those, especially in taxable accounts. So it's kind of, the answer might be very personalized to an individual, which kind of gets to this point around, you should probably have a consistent model portfolio, but the path to get there is going to be very different person by person, given the types of accounts, how the assets split, legacy positions, things like that. Working their way through as you work to rebalance maybe an incoming portfolio into the steady state portfolio, and just trying to think about how to smooth that ride over time and get you into a better spot.
The one other comment I'd make on that, and again, this is kind of the practical how to think about it, or things to consider. One of the things I almost know for sure is when somebody comes to see us and a prospective client, and they have account, and you see this all the time. They have accounts all over the place. They have accounts at brokerage firm A, and then an old 401k, and then they have this over here. There's almost in no cases do they have an actual asset allocation plan that is being rebalanced, because just having consolidation of your accounts is one of the key things, or at least a 360 view of how much you actually have in stocks in any given day. That's really hard for a lot of people to answer because they have things everywhere. So you'd have to go pull all those statement values or go online, look them all up, figure out what the stock bond mix is on each one of them, aggregate it. So I would just say, where possible, I think a lot of times people think, well, I like having the diversification of having different things all over the place. There's enough options out there now where, whether it's a Fidelity, a Schwab, all these different investment firms, you can own T. Rowe Price, or you can own Dimensional, or you can own American Funds or Vanguard at any of these places for the most part. So I would just encourage people, consolidate your investments. It's going to make this process a whole lot easier to know what you have, because if you have to manually go out and grab all this data, you're probably never going to do it. Or if you are going to do it, it'll be once a year.
Yeah. Any other closing thoughts for you?
This is a third in our series of portfolio management. Hopefully, what people have learned over this full series is there's lots of thoughts that go into this. Kind of going back to the continuum theory, like you can simplify it as much as you want by using kind of prepackaged products and really trying to make it as simple as possible. And, levels of complexity you can add to it. Just be careful whenever you are adding complexity. Is it adding value? And if so, is the juice worth the squeeze, basically, for people? So I would just be thinking through whether it's, how you're thinking about your asset allocation, how to add in international versus US, how you rebalance. All this can be done pretty simply, or it can be, you can add some complexity. We kind of look at it as, if it's going to add value to our client situation, we're going to figure out a way to do it. But if you're an individual investor that this isn't your full-time job and you're just not looking to do this, and you don't want to hire an advisor, think about, are there ways I can simplify this?
Simplicity sometimes is really elegant. If you think about a duck kind of swimming across the water, super graceful on top, a lot of furious kicking below the waves there. So that's a lot like how your portfolio should be. It looks easy. You could stick with it. You don't have to think about it, but there needs to be that complement to keep you moving forward. So with that, I guess, Pat, do you want to tease our next guest before I forget? You did make a reference to Inside Baseball earlier.
That was on purpose. Yes. We are really excited to have Katie Griggs, the president of the Baltimore Orioles, is going to be our next guest on the podcast. She is kind of in charge of all the business side of the Orioles organization. She's come from kind of different organizations as well, so she has some experience with other franchises. I am so excited to get into the business of professional sports. Many of you know the Orioles have a new ownership team over the last couple of years here. So we're excited. I think if you are an Orioles fan, number one, you're going to want to, listen to this podcast. If you're just a sports fan or business fan in general and want to understand more about the business side of how decisions are made inside of franchises, it's going to be fascinating. So I'm really excited that she's going to be on the podcast.
Yeah, she is so smart. So we're lucky to have her.
Great. All right. Well, happy Thanksgiving to everybody.